here we are now presenting that May 12, 710 call that we have 15 contracts. And this is the earnings preview for Google. It is the April 12th, 2012. It is right now 9:18 a.m. Pacific Standard Time. Once again, to all our friends and all of our friends, is that we had to purchase contracts over here at $4.50. Yeah, and we're buying them for $5.19. And the high over here, once again, was $10.10. So if you take the wholesale prices that we have saved on our entry, so you go 10.10 pennies and you minus 4.50 pennies, and you just saved 5.6 times 15 contracts equals $8,400 I have taken out of that top end risk to our entry. And in order for me to participate, I felt it was my due diligence to get the price as wholesale as I could, as close to the earnings date today. And that the contracts, if Google reports well and Wall Street likes them, just like I put why we put money on the put side of the trade, but we have the call side now. And we have to take a look at where our upside target is, which would also equal those profits against the other side of the position. So if these contracts were to pay $12.50, that would be an $8 move. And if you take 15 times 8 pennies, which is $8, that equals what? $12,000 on that trade. If they really blow out the number and guide the quarter higher, these things could go higher. That's all good and well. That's what the bull side is. I am telling you, MMT, that our dollar cost capital risk has been minimized to the best of the ability for the time frame that these contracts have traded to our entry of $4.50, because they don't move much. You can see that. All right? So, therefore, we've taken that risk, that dollar capital risk out. One of the things that we would like to emphasize is, to us in our market making school, for the time element that we have called the time series entry now, is one thing that you're always taught is to respect the dollar cost capital risk entry. And most people, they get excited and they probably own these same contracts up here at $9, $8. Doesn't matter, but that's where they own them. They owned them, they bought and held them here. When they even made the high, they never sold them. No, they never did. Public doesn't. We know. Fine. I hope that they work out for them for the duration of time that the public has held them, because it's a May 710 call, and this is all the time frame that they have on this daily chart right here, right now, and it's a call chart. Having said that, that's the upside cap. Now I understand from MMT that we bought some of these 760 calls up and out of the money. They were $3.50. I will ask them what our cost is, and that once again I did not buy up here, and I will show you my cost savings. What we did do, now I'm back live here. Yes, I will agree with you, MMT. 100 contracts that people were buying on the call side, that purchase here in 328, they gapped them up. Of course, no one ever sold them. But yes, the same purchase here would have been a $35,000 purchase, because on 100 contracts, it would be that much money. And people own them over here at $2.40. That is $24,000 on 100 contracts. Now, we're buying 100 contracts down here at the discounted price for up and out of the money May 760. And they are discounted. If Google does great earnings, these contracts can go up. And even if they only go back above 350, it is possible that if Google gets a gap and then had a 4-week breakout, these contracts could be worth a lot of money. The upside, it's what the upside is worth. We're wholesale. We have 50 of them right now at $1. And we couldn't have gotten them too much better than that. Yeah, 85 cents was a low yesterday, and we were trying to, actually we did have some, or we were trying to get hit yesterday here at around 60 cents. However, we did move in, so we have $5,000. So the thing about it is, even if they only went to 350, that's still 15,000 profit that we're looking at. And when we look at the downside versus the upside, based on an earnings, if they do the earnings well, those contracts could easily go to 870, and that would be the upper end, 870 by 920. Of course, you'd have markets made between 750 and 790, providing that Google gapped up and blew out the earnings this afternoon. You could look at that kind of price increase, and it is possible that that could happen, but our risk is minimal. Buying the 50 contracts up here, even at $3, would have been $15,000. And I have taken that $15,000 so there's $15,000 or even $10,000 right over here. If I was buying at $250, it's over 10 grand. I'm still taking out that dollars. Those are dollars. Those are risk. And I'm removing that risk with my entry. That's a 760 call. I understand that we have what? A 750 call? Here's a 750 call. Is that the one I have? Here we go. This is a 750 call. And we bought these 750 call for May's up and out of the money. What I would like to say is that we have 20 of these. Is that right? So the thing about this, what? We have 20 of them, right? So, all right. So we took out $5,800 of risk. If you owned them up here, 20 contracts, this was 10 days ago. 1 day, 2 day, 3 day, 4 day, 5 days. 1 day, 2 day, 3 day, 4 day, 5 days up here. So we own these at $1.50 times 20. The thing about it is, it's a 750 May call. And it was the only, once again, wholesale entry that we could get, and removing the $5,800 worth of upper dollar value risk. And even if I'm doing right here, I mean, people that own them at $3, and let's say they own them at $3.50, I'm still on 20 contracts $2 below those prices, which also, that's $4,000 of that $5,800 of capital risk that I have removed to the best of the ability to be invested in Google. And I did not do the weekly expiration that expires tomorrow on Friday. No. Nor did I do the other expiration for April. No, I did not. No, I did not. I went out to May because that was the best discounted market that I could get for the best value for the duration and the time frame that the market would let me make a market. What I would like to make clear, that it's always going to be what you are taught here as an MMT is the risk management is priceless, because when you add up all of the dollars that you take out, all of the cost dollar risk that you take out, and you multiply that, it could be several million of wholesale dollar entries where other people lose. And you, for the time frame that you have, and you want to be invested in Google for a lower dollar capital risk. And you'll have to get a good sized gap off of the earnings, though, to get these contracts above these highs. We break back or higher here. If these go to $7.50, these go to $7.50, well, that's a $6 profit times 20 contracts equal another $12,000 potential upside profit. And so when you look at the dollar risk profit versus your downside, which is $1.40, and your upside is unlimited with the good earnings report. And that means that, yes, they shook these down out of the May contract, and the retail people bought them here. But what does the MMT get taught to do? To buy that lower end of that position. $5,800 worth of risk taken out of here, and just even for the last part of the big buyers up here at $250 in them, hey, we're still $2 below the market times 20 equals $4,000 wholesale of that $5,800 of dollar capital risk removal in price action. One thing I am going to tell my MMTs is, should Google do the right, correct reporting that 9 half deltas in our system, which is $34.50 from the current price print, to get to 9 deltas, that's 678.26 pennies, which would be $7-8, or would be about, little over $7 higher from our short at 670. All right. Now, the thing about that, having said that, is that if we were to go up over the next couple of weeks, and they did provide good earnings, Google could start getting inflated right around, let's say, we would go 15 in the short term, we would go 15 delta, half delta prices. That's $65 from this current level today. And that would be 15.5 delta in the SMF pricing system, I must say so. Okay? And that is 65 handles. If we go to the 13.5 delta mark, that's going to be $699.41. That's $55.91 higher from the current level to go through today all the way through May, should they give good upside earnings. A 12 delta mark is $48.43 from the current print. That would be 692.36 pennies. Not only that, the shorter delta range that we would be looking at would be 7.5 delta, and that would take out that last high reversal at 671.21. And that is $27.40 to get there on a good earnings report, and then the trend would continue to go higher in the delta tree, because people need to chase performance and they need a good story. Google provides a good story. Institutional managers are going to want to suit it up, and they're going to want to buy it, and they're going to want to buy it now, or they're going to have to pay a higher price after the closing bell. If everything goes well, those same managers are going to have to pay who knows how much higher. $20, $40, $50, $60 higher? Very well could happen. It's happened before. So these are all the possibilities and some of the price levels we're going to be looking at. On the flip side, though, if it was to go down 7 deltas, that would be $603.06 that we would be looking at. That's $40 below the current print, $40.90 at 7 full delta. If they were to take it down to 5 delta, that's $31.57 lower. That's negative 5-point ratio in the SMF platform would be 612.46. All right. Now, should they get exuberant and want to go 9 deltas the opposite way, of course we're going to be buyers down there. That would be 593.66. That's 9 full deltas. That's $50.32 below the current Brent. And we would be big buyers there. And the following morning, to offset any costs that we have in our current position ahead of the report, we would go right in at those lower lows and buy that up and offset the whole trading block of shares of calls and puts at that time. Those are called backdoor entries. So I am happy to conclude the fact that we do have some price levels. I will tell you that 6.5 delta is 605.41, and that is minus $38.48 below the current marketplace. And any one of those levels down there is where we would look at actually getting entries long and after hours and just trade that for a killing. But I'm going to conclude, so far I've covered all of the calls and what we paid, what our upsides are. Google's trading at 645 in the delta tree. And the thing about it is that, once again, the fundamentals are sound. If the economy is doing well, then you know that Google has to do well. It's a leader stock, right along with the price line. How great leader this is. It's time for it to deliver the results. If the results are delivered, you're walking away really nice. And you have enough time for the weekly trends to continue to go higher. You know, they pull back and then they bounce and they make higher highs. It's all going to have a solid report. And that earning revenue structure, the input and output and input, there has to be a balance in those company revenues. And as long as those company revenues have been adjusted accordingly with the profit structures in there, then Google remains cheap and needs to trade up to a valuation level of at least 720 to 740 over time, the upper end of the value, to catch up to its peers. And also, it's not overbought on the weekly chart. I will show you a Google trade right here. I'll show you the weekly chart. It likes to come down and test these weekly moving averages. From a technical public point of view, you're not overbought like you were. You've been rising each day on the percent DS, but you're at about 69.76. So that's and the thing about the weekly is you go right back over here to these old tops. That's 745. You can see that 708 area that you heard me talking about. And probably there's something right in here. So there's that 679 handle you probably heard me talking about that I was showing in the MMT platform. This is just standard stuff. You can take a look at where these highs were up here. And this is on a weekly level. And the calendar years are right down here in the dates. So what I would like to show people very finely on a weekly chart, and this is for the retail public, 747 was a high reversal. I remember it because I was getting short back then on it. And then it popped up, and then that was the end of it. But let's take a look right here at the 2007 high at 702.49. That's one area. Let's take a look at this area over here in the short term. Is going to be 662.28, and that was on 1/6. Okay? So we're looking for good news gap to be gap above this price area that I'm highlighting here. All right, and that you get into this part on a good report. You get into the areas depending on how that bull, but this is going to be that weekly top, and this is what it looks like on a standard thing for the public. Standard. And these are the dates. 2008, I mean 2007 was a great year. We were shorting it and going long both, didn't matter. But we did get a short on Google for a long time until it was viable at 250. I will tell you though that these highs over here are going to be the key. And this last high is the one that we shorted it. So let's draw a trend line right here. We'll get that tool for you. Let's go to trend tool. Let's go to right there. That's 669. But we were at, we said it would go up from here to 670 and then drop to 580, and we bought it again. And the thing about it is we bought several times in here, at that bottom and this bottom. It didn't matter. Okay? And basically what I want to show people is that is where the 2012 high was, where we shorted it. We traded $100 up there. Yes, we did. Yeah, we did. And that's when the bear was really in play last year. But we had a big bull run right here on a weekly buy signal. So the weekly buy signal is still in play. As far as that goes, these are going to be the price areas. There is 693. There is 688 handle right up in this area of where it will take great news to get it back up to its current. That means that Google is worth more money than it was back then in price, EPS. But that earnings per share balance has to come out there. But we removed the risk. And one of the things that we showed the calls and the put side for what the premium was willing to give. Rather, they steal more premium from those levels, because those transaction level could not have been done much better than what they were. Very little room in there from the time that we were allocated to be able to buy them, but the discipline that we used, and we used a lot of discipline. Once again, we never want to see the money on that 590 put, but we had to buy it. And that was a short-term one, just in case there isn't good news. And yes, we would love to lose that money there and get paid on the upside. So that's the way we look at how we do business.